If you are retired or close to retirement, there's a money question that can keep you up at night. Should you throw extra money at your mortgage and get rid of that payment forever? Or should you keep your cash liquid and protect your flexibility? A lot of retirees are trying to make sure their income will be sufficient and predictable, and housing costs sit right at the center of that worry. Let us start with something simple. A mortgage is not only a math problem, it is a cash flow problem and a sleep at night problem. Some people want to eliminate the payment because it feels like a weight on their chest. Other people want to keep cash available because life does not send bills on a polite schedule. Both instincts can be rational. So here's the core idea. Paying off a mortgage early can be a great move when it lowers your monthly baseline and removes a risk you cannot emotionally tolerate. Paying off a mortgage early can be a bad move when it drains your liquidity and forces you to rely on credit cards, withdrawals, or panic selling during a bad year. Now, I want to give you a framework that you can actually use. Think in 3 buckets: safety, flexibility, and cost. Safety is the ability to cover your essential monthly bills without stress. Flexibility is your ability to handle a surprise without breaking your plan. Cost is what the mortgage is truly costing you after you consider interest, taxes, and what your cash could do elsewhere. You want all 3, but you will usually prioritize one. Let us talk about when early payoff truly reduces stress. The first situation is when the payment is the number one stressor in your budget. If your monthly mortgage payment is the thing that makes every month feel tight, then removing it can lower your baseline in a very real way. In retirement, lowering your baseline often creates more peace than chasing perfect optimization. The second situation is when your income is stable but not large, and you value simplicity. A paid-off home can make budgeting easier because your biggest bill becomes smaller or disappears. The more you hate tracking and adjusting, the more valuable simplicity becomes. The third situation is when you are close to payoff already, and the remaining interest cost is not the main point. Sometimes the final stretch is more about psychology and freedom than spreadsheets. If the remaining balance is small enough that paying it off does not damage your emergency reserves, the emotional win can be worth it. The fourth situation is when you have a high personal stress rate. Some people are calm with debt. Some people feel physical anxiety with debt. If carrying a mortgage makes you lose sleep, lose appetite, or feel constant pressure, that stress has a cost, even if it does not show up on a statement. The fifth situation is when your household has a strong liquidity cushion even after payoff. If you can pay off the mortgage and still keep a healthy reserve for emergencies, medical costs, home repairs, and car issues, then you can enjoy the lower baseline without creating a new vulnerability. Now let us talk about when early payoff can hurt you, even if it sounds responsible. The biggest trap is liquidity loss. Retirees often learn this the hard way. Equity in your home is not the same as money in your account. It is real value, but it is not instantly spendable without friction. If you pay down your mortgage aggressively, and then you get hit with a roof repair, dental work, or a family emergency, you might end up using high-interest credit cards or taking withdrawals you did not plan to take. That can create more stress than the mortgage ever did. Another trap is house rich, cash poor. This is when you have a beautiful balance sheet on paper, but you have limited cash flow flexibility month to month. The paid-off home feels safe until the first year, where multiple surprises stack together. A third trap is opportunity timing. If you put a large lump sum into your mortgage and then an unexpected expense arrives right after, you cannot easily reverse the decision. That is why many retirees prefer a gradual approach rather than a dramatic payoff event. A fourth trap is ignoring other high-impact risks. If you still have expensive consumer debt, if your insurance coverage is weak, or if you have no emergency fund, focusing on mortgage payoff can be the wrong first priority. A mortgage is usually structured and predictable. Random emergencies are not. A fifth trap is emotional overcorrection. Some people pay off the mortgage and then feel so safe that they stop tracking spending entirely. Then the budget drifts. The mortgage payoff was not the problem, but the mindset shift can be. So what should you do with all of this? I cannot tell you what you personally should do, but I can give you a decision checklist that tends to produce better outcomes. First, define your minimum cash cushion. Ask yourself, if my car breaks, if I need a home repair, and if I have a medical surprise in the same year, do I have cash to handle it without panic? If the answer is no, a large mortgage payoff may be premature. Liquidity first is not exciting, but it is protective. Second, measure your baseline without guessing. Write down your essential monthly costs. Include housing, utilities, insurance, groceries, transportation, and healthcare. Then ask, if the mortgage disappears, what changes in my stress level and my monthly breathing room? If removing the payment transforms your baseline, that is meaningful. Third, run a bad year test. Imagine a year where markets are down, the roof needs work, and you have one big medical bill. In that year, which decision helps you more, lower monthly payments or having cash available? The correct answer depends on your cash cushion and your temperament. Fourth, Consider a middle path that people forget exists. You do not have only two options: pay it off tomorrow or never pay extra. Many retirees choose a hybrid strategy. They make small extra principal payments, but only after their emergency fund is full and their yearly bills are covered. This keeps progress moving without draining flexibility. Fifth, separate the emotional goal from the financial method. If your true goal is, I want to feel safe, there are multiple ways to get there. Paying off the mortgage is one way. Building a strong cash reserve is another. Having both is ideal, but even choosing the right one for your personality can be enough to sleep better. Now, let us add some real-life nuance that matters in retirement. Housing costs do not end when the mortgage ends. Even with a paid-off home, you still have property taxes, insurance, utilities, and maintenance. So do not fall into the trap of thinking no mortgage equals free living. The mortgage is one large line item, not the whole category. Also, retirement is a phase where flexibility can be more valuable than maximum return. If liquidity prevents stress decisions, it can indirectly protect your long-term plan. For example, having cash available can keep you from selling investments in a down market or from taking large withdrawals in a bad year. That kind of stability does not look impressive on paper, but it can be powerful. Let me give you two simple examples, just as thought experiments. Example 1, early payoff helps. You have stable income, you have a full emergency fund, and your mortgage payment is your biggest monthly stressor. Paying off the mortgage lowers your baseline, and you still keep enough cash to handle surprises. In this case, you are trading excess liquidity for peace and simplicity, and you are not becoming vulnerable. Example 2, early payoff hurts. You use most of your liquid savings to wipe out the mortgage. 3 months later, you need a major home repair and a car repair. You do not have the cash, so you use credit cards or you take a rushed withdrawal. Now you're stressed again, but the stress is worse because it feels like you did the responsible thing and still got punished. In this case, the problem was not your character. The problem was the order of operations. If you want a simple rule to remember from this entire video, it is this. In retirement, you want fewer mandatory payments, but you also want fewer moments where you have no good options. Early mortgage payoff reduces mandatory payments. Liquidity protects your options. Your job is to balance both. Here is a practical end-of-year or once-a-year routine you can do. Review your cash cushion, review your monthly baseline, review the condition of your home and car. Then decide whether extra mortgage payments belong in next year's plan. And if yes, how much you can do without shrinking your safety buffer. If you want, comment with your biggest concern. Is it the monthly payment stress, or is it the fear of a big surprise expense? I can create a follow-up video that focuses on building a retirement shock absorber fund or on a step-by-step baseline budgeting method.